We've talked about how banks try to reduce the earning gap and the duration gap through asset liability management so that changes in interest rates don't have an adverse effect on the bank's net interest income or the economic value of the bank's equity. But banks also care about managing the cash flow gap, aka the maturity gap, because a mismatch of maturities for the bank's financial assets and financial liabilities could result in a cash flow shortfall. And that could lead to the bank having to borrow at exorbitant rates or paying a lot more for funds than what they thought they were going to have to pay. Or in a worst case scenario, if the bank can't come up with cash flow at all, the bank becoming insolvent. Okay, so let me give you an example of how this could play out. Let's say that a bank raises 50 million euros by issuing a one-year note. Then the bank takes 30 million of those euros, lends them out for 15-year mortgages. Okay. Now, the bank is probably assuming that when this note matures in 1 year, that they could just roll it over and get another one-year note or borrow again. Or so. But let's just say that when that note matures in 1 year, that there's a financial crisis going on and the bank can't roll over the note. And worst case scenario, the bank just can't get any alternative source of funding lined up. That bank is going to have to repay 50 million euros. Okay, they're going to have to pay that 1 year, and they're still having to wait 15 years to get the euros from the borrowers. Okay, so they only kept 20 million. So the difference between the 50 and the 30, they only kept 20 million euros on hand. Now, they got a little bit of interest that first year as the borrowers were paying their mortgages, hopefully, but they still are not going to have 50 million euros absent them being able to either roll over this note or get some other source of financing. So what we have here, there was a mismatch of the maturities, right? The liability matured in 1 year, whereas the assets, it was going to be 15 years to get repayment of the principal. And because of this mismatch, now that the bank can't roll over this liability or set up some alternative source of funding, now the bank has a cash crunch and they are not going to be able to repay this note, which would lead to the bank becoming insolvent.